Happy almost Thanksgiving, everybody. Now, I'm personally not a huge turkey fan, which is why I'm so thankful this year that Baskin-Robbins is bringing back their turkey ice cream cake. I'm lying, that looks horrible. But even though I hate turkey, today I want to start out with a story about turkey. And don't worry, there's an investment related point to all of this, so stick with me. This turkey story actually comes straight from Nassim Taleb's Black Swan, which is a book about more than just birds. I'll go ahead and do the opposite of paraphrasing it for you. So imagine that you own a turkey named Jack. And every day you care for Jack, you shelter him, and you feed him great food like McDonald's French fries and Baskin-Robbins turkey ice cream cakes. The whole time just making him fatter and healthier. And Jack is sitting there thinking, wow, this is great, gobble gobble. It really looks like this guy cares about me, gobble gobble. Time goes on and Jack grows to feel more and more safe and secure with you. But eventually the Wednesday before Thanksgiving rolls around. So you go out to Jack's guest house and wave a French fry in front of him like normal. But when Jack goes to eat it, you take that cleaver out of your pocket and chop his head off. And now Jack, with his head on the ground, is thinking, what the hell, gobble gobble? I cannot believe this guy beheaded me Game of Thrones style. I thought we were super cool with each other after all that time and that HBO subscription we shared, gobble gobble. It's as Taleb said in his book, the turkey's feeling of safety reached its maximum when the risk was actually the highest. Now, does Jack's story remind you of any investors you may know? Maybe the ones who just blindly buy and hold index funds and ETFs? Who are so confident and feel so safe and secure with their strategy, even though they'll probably get slaughtered in the next downturn? Yep, today we're gonna talk all about passive investing and the turkeys that partake in it. And it's all going down on this week's episode of Real Vision's The One Thing. What's happening, investors? AK here. Over the last decade, passive investing, which as I explained is basically buying and holding ETFs and index funds, has grown to dominate the market. $1.7 trillion have flooded into passive funds from 2006 to 2017. It's crazy. And the whole idea behind this strategy is to buy something like an index ETF, which has low fees, and to just hold on. That's it. Whatever the overall market does is what your account does. And this actually works really well in a bull market, kind of like the one we've had from 09 onward. You would have looked pretty smart and cool going passive. Kind of like a turkey, just chilling, eating McDonald's and watching Game of Thrones every night. The active investors are the ones who look dumb. A 2016 S&P Global study showed that about 90% of active managers failed to beat their index targets over the previous 1, 5, and 10-year periods. And of course the media knew this, so they were putting out headlines every day about the death of active investing. But here's the thing, markets, they move in cycles. So there'll be long periods where a certain strategy will work, but equally long periods where it won't. And it's usually when things become too good that everything shifts. It's just like Taleb said, the turkey's feeling of safety reached its maximum when the risk was at its highest. And that's what we may now be seeing with the passive crowd. 2018 has been nothing like the past 7 years. Volatility has come back with a vengeance, and we've seen serious selling in equity markets from China to Europe. US mega cap tech stocks are already 20% off their 2018 highs. And we have bonds selling off for the first time in a generation. The ETF TLT is down 10% in 2018. See, it's in these types of volatile markets where active managers start to shine and earn their keep. And the passive crowd, well, they start to suffer. Buying and holding is real easy when the market is going straight up all nice like, but when we start getting swings like the ones we've been having, not so much. And the issue is that things have gotten so extreme that a recent report by JP Morgan revealed that there's as much as $7.4 trillion of selling pressure built up in the passive space. So imagine seeing the higher volatility coming in, which gets a few of the passive guys to start selling. But because there are so many of them with so much money, that selling moves the market significantly lower, which scares the other passive turkeys into selling too, and pretty soon you have a huge magnified drop lower from all that passive selling. See, the problem with this whole passive mentality is that these guys don't stay passive when the going gets rough. You could call them fair weather passive investors, because when the pressure is on, all of a sudden they'll become active and sell out at the worst possible time. And what's even more dangerous is how retirement accounts and pensions rely on this passive strategy. Just check out this clip of Raoul Pal talking about it in his classic video on the coming pension crisis.
In a rising equity market, this kind of makes sense. You're clawing back some of the ability to retire. But if things change, the picture gets a little bit worse. You see, the one bet people are taking is they're actually putting the maximum allocation in all of recorded history across the entire system into risk-seeking equity-like assets when equity valuations are off the charts.
So please, don't be a turkey. Avoid what happened to our turkey friend Jack by signing up for Real Vision and learning from the best active managers in the game. I'll talk to you soon.